Okay, people, thank you. I think we'll get underway. The weather is almost as interesting as the economic environment we find ourselves in, and we might hear a little bit about that today. Maybe not too much on the weather, but certainly about the economics. As those of you who have been with us for some time will be aware, platinum have been a part of our story since they started, and in fact for some of the original platinum guys, they were part of our story when they made Bankers Trust in Australia the force that they became. And it's interesting to see the changing of the guard. We have an up-and-coming enterprising young analyst at the back, Mr. Kerr Nelson, who founded this business some time ago and has now stood down and handed over to Andrew Clifford, who I think most people here have met on one or two of his visits to New Zealand. But the guy that we'll be hearing from with the presentation today is Julian on my right. But when we get to the end of the formal presentation, Kerr is happy to take questions as well as Julian. So, if you'd like to greet Julian in the normal manner.
All right, we'll lead away. I just want to tell you a few brief stories about the world economy. They're not necessarily true. They're not necessarily complete. But what we're going to try and do very quickly is just sort of fill in some of the details around the global economy. We're all bombarded with information. We're all bombarded with stories about the place that probably make us feel a bit worried. So we just want to focus on a couple of areas of the world economy that maybe don't get fully explained to people very well as addressing some of those concerns. That'll be pretty quick, but please do think of questions. Don't sing them out to me. You can if you want to, but please do pose some curly questions for Kerr after the sort of formal session is complete, which won't take long. So you'll have plenty of time for questions. So just to focus on what this year has looked like from an investment point of view, we've had a series of sort of rippling concerns. And I just do want to emphasise to you that the core of those concerns is tightening of credit in China. So we get a whole lot of news flow about areas of the world economy that are salacious or historically important. Please do note that China is the world's largest economy. Now you'll know I'm a liar when I say that, because you'll say, hang on, the US is 20 trillion and these guys are 13, you're lying. Just think about your mobile phone, right? So that little gadget is cobbled together for about $6 in a Chinese factory. The total bill of materials that comes from about 25 countries is $250. So that thing exits China at 256, so they get 256 in their GDP accounting, and that magically appears somewhere else. In that somewhere else, it then gets sold or re-exported for 1,000. And the GDP accounting goes positive 256, negative 256, positive 1,000, for a net 744 for the guy who sold it. That's interesting, right? Now multiply that across everything you are drinking out of and touching, and so that manufacturing logic is in all of this stuff. There's embedded margins in all of these accounts. So please do note that if you want to understand the world economy, you have to understand China. And so from about January this year, it became pretty apparent that China was tightening credit. And that tends to get presented as some sort of, ineptitude or madness or shell game, or it's reform. Right? So it's very, very deep reform of that economy. And I'll come to that. You don't do that because it's going to feel good this quarter. You do that because you're rebasing your economy to grow sustainably thereafter. And possibly Australia, I don't know about New Zealand, but possibly Australia could have done with a bit of credit tightening along the way across the last 30 years, potentially. So from that central concern, you get these ripples of further concerns. So, Europe, trade wars, tariffs, all these other things. The layer cake effect of all these things has been to sap investors of confidence, and we've seen that in markets this year. Now that has affected not just confidence, but activity. We'll talk about that. But what I want to emphasise is you don't want to get too scared too quickly, because you might miss a few chances along the way. Because the things that are very expensive are obscuring things that are very, very cheap. So these squiggly lines, and forgive me, I like squiggly lines. These squiggly lines are what the world looks like broken into US market, the US equity market, and the rest of the world this year. So you might think everywhere's had a pretty good setback in the last month or two, but actually the rest of the world's done a lot worse, having done a lot worse over the previous 10 years. So you've had no closing of any relative gap of US equity markets versus the rest of the world, which is interesting. And what that's led to is this incredible relatively high valuation. Let's not use sort of judgment terms. This is the US equity market. It's price to earnings and price to book, so it's both the assets and the earnings, relative to the rest of the world. It's a 30-year series. So what we're looking at there is this place is about as expensive as it's ever been relative to all the rest of the world shares. Now I'm being a bit dumb because I'm saying, the US versus the rest of the world. We don't buy countries, do we? We buy companies, but I'll fill that out a bit further. Because the next slide is a bit more relevant to what you can actually own, and that's sectoral. So this is software type businesses. They're all good businesses. They all can grow pretty quickly. Your wonderful Xero is a good example of the kind of business I mean. So it's a services, software type business, doesn't need much capital, has a very valuable business in which to grow. So, online accounting type stuff. You can talk yourself into it. You know there's a good story there. But just be careful at how expensive that kind of business is relative to a whole series of other businesses. And those other businesses are cyclical. Right? So what investors are herding towards is safety and growth, and they want to get away from anything that's cyclical. Now remember, we've got this worrying year, right, with Chinese tightening and tariffs, and so the last thing you want is someone who's a price taker, whose revenue line wobbles around. Investors don't want that. They want safety. So they're herding into one part of the market and away from the rest of the market. This wiggly line is that software type business versus materials, so miners, energy, that kind of business. So please do note that's very extreme. It's almost where we were in 2000, and I hope you remember how that ended. Not a prediction, by the way. Now, just to hammer that home with some numbers, if you look at the year to date, so the year to October, and you look at the contributors to what people are measured against, which is an index, which is called the MSCI All Country World, for some reason we need both names, the contributors to that in terms of returns, of the top 10, the average valuation is 38 times earnings. Now, who cares? Because I'm a finance guy, I like to overcomplicate things because we're not very smart. So if you go to a bank, you get a yield, right? Businesses give you a similar thing. So if we invert that multiple, we get a yield. So these businesses are giving you less than 3% as an earnings yield to own them, right? So less than 3%. I don't know, can you guys get better than that in the bank over here? You get about that in Aussie in term deposits. So that's for taking the risk of owning these businesses. That's the kind of businesses that we're heading towards. Of those top 10, none are outside the US. Of the top 50, you're getting an earnings yield of a little bit less than 4%. So a bit better, still not spectacular. And of those, 8 are outside of the US. So 8 of the top 50 stocks in the world this year are outside the US, which is really pretty weird. Now, the rest of the world has problems, but just do question yourself as to whether one part of the world is that perfect versus everybody else. So let's just address a couple of these concerns that are really weighing on people's minds. So tariffs and trade are one. So the Donald is having an effect globally. And the other is rising rates, which we do have to accept is going to happen. Now, that's a normalisation rather than some sort of excessive tightening, we think. But just to put this in context, the little bar is the total exports from China to the US. It's 500 billion. So when the Donald gets really worked up over his morning tweets, he will tell you that I'm going to tariff all 500 billion of Chinese exports to the US. Big number. But that's 500 over a base of 1,300. So it's, it's 4% of that economy is what we're talking about. Now, so why are we so worried about it globally? Why is the investment community so worried about it globally? A couple of things. The first is not very concrete, but it is very important. We have a rule-bound system for dealing with trade disputes going all the way back to the General Agreement on Tariffs and Trade, which was signed in 48 or something. Now, that's very important, and you really don't want to disrupt that if you want an orderly world. So that point is sort of nebulous. But the other important point to think about is, what do you do if you're running inventory, if you're organising a supply line in Hamburg or Seattle or Guangzhou, what do you do with your inventory next month? Because you don't even know what tariffs will apply to what products at what rate. As of January 1, you have no idea. You know today, but you don't know in a little over a month. But now think about, well, okay, that's fine, but maybe I should build some factories in Cambodia or Vietnam or Bangladesh to avoid these China tariffs. But now, do you know the tariffs will be in place in 3 years' time? No, you don't. So you're very unsure about what to do with your inventory, and you're totally unsure about what to do with your capital. So that really weighs on confidence. So that confidence effect is very real, but it's not demand destruction, it's sort of demand deferral. And you can see this globally. So this is a thing called a Purchasing Managers Index. So you know how I was saying before, imagine you're running inventory. There's a survey globally of people who do that. And they're asked, are you going to order more or less next month? And this is only people engaged in export industries. Top line is the US, bottom line is China. And look at the confidence sapping effect this activity is having globally. Germany, by the way, looks even worse. So Germany has plummeted from very expansionary to really quite negative. So globally, we're all worried about this issue, and we're right in the teeth of that uncertainty right now, because we do not know what the outcome can be. So just think about what might change with a little bit of certainty. Even if the outcome is poor, you then have something to base on. You then have, a basis for making decisions. So that's the setup for trade, how we think about that. The next point is rates. I just want to put this in context. We've come off the zero bound before. We've had zero interest rates before. This chart, this squiggly line, is from Ray Dalio's, really quite masterful book, a template for thinking about big debt crises. It's an amazing thing. It's free. Go and download it. There's 27 different debt crises summarised. The point here is we have done this before. So we've had zero interest rates from around about 36 to around about 1946. We had around about zero rates. So that's just to put that in context. And also, interestingly, we funded a world war in between, and we did that with bonds, which is kind of interesting too. So it's kind of similar. There's a few advantages back then. I won't hide from that. A couple of points. It takes a hell of a long time to normalise after that. So after the Great Depression, you don't get above 3% until sort of the mid-50s, right? Now, the other point to note is look at the steepness of the line in the most recent one. We are really, going quite aggressively back towards a rate normalisation. Now, that's both a good thing and a bad thing. It is clearly affecting investor sentiment, but it's also normalising the cost of money. So it's putting signals back into the economy. Now, that is disruptive in the near term, no question. It affects confidence, but it's also a very, very sensible thing to do. It lowers the chance of maniacs doing crazy things, not to put too fine a point on it. Now, just in recent times, as rates are going up, you are getting early evidence of a bit of distress in credit markets. That prior long-term series, that was the cost of money that people lend to a government in bonds. This is the spread that you charge to people who are not perhaps the best lenders in the world. So this is high yield debt versus 10-year treasuries. And that line, as it goes up, is indicating that there's a bit more worry about those people's business. But let's put that in context, because this is what that looks like over a longer period of time. So that circled area is the level of distress that we're now pricing versus history. The very big spike is the GFC. Note how high we were in 2015-16. So, and we're way below average. So what I want to impress upon you is the cost of money is returning to markets. The cost of lending to people who are perhaps not the best borrowers in the world is also normalising. It's just going back towards the average over the last sort of 50 years. So don't get too distressed about the level of distress. That's what I'm trying to say. And then just to look at a few areas that are maybe a bit more interesting, that we think you might be able to find some interesting stuff. And the first is China. Now, this squiggly line is pretty amazing. This is rail freight movements. So it's a volumetric thing, there's no price. It's just stuff moving around the Chinese economy. The circled areas, that first circled area is the GFC. And then the second circled area is 2011 to 2015. So China had a massive industrial slowdown for the better part of 5 years. And they told you they were doing it. They told you they were doing it. They said, we want to rebalance this economy. And try to remember how lousy the world felt in 2015, right? So the oil price is $28, copper price is $2.25. You've got stories of debt crisis and deflation and all that stuff. That's right in the teeth of an enormous change in the nature of the Chinese economy, right? So it did a couple of things around that. It consolidated capacity, it shut capacity, and it eliminated some overcapacity. There's still plenty of overcapacity in that place, by the way, but they've shut around about 200 million tonnes of steel. So what does that mean? Global industry is about 1.6 billion tonne, and when you shut 200 million, you've just shut the Japanese and Indian steel industries. So the second and third industries in the world. You've shut that. You've also shut about 800 million tonne of coal capacity. So what does that mean? That's around about double the Australian coal industry. Not quite, but around about that. So these are very serious moves to reform that place. And now we've moved on another step from there. So final point to make on that chart is you've then recovered. You haven't gone back to peak levels. Well, you've gone back to close to peak levels, but you've recovered well out of that, that very, very pronounced slowdown. The other point to note about that, though, is that that's a very significant change in that economy, and think about what the prices have done. So don't accept my word for it. You can go and check what oil prices and plastics prices and copper prices and freight rates and all these things have done since that time. They're global prices, and they've improved dramatically. Now we have to marry that back to where the debt is held in China. It's in heavy industry. It's about 160% of GDP in sort of heavy industry, state-owned enterprise stuff, and they produce the stuff whose prices has gone up. So debt service capacity has improved, right? So think about the last time you heard about a sort of China crisis type story. It's changed a lot because of this reform program. Now, just finally on this stuff, the last little bit of this has been now addressing the rampant credit growth that's gone to the consumer. So Chinese consumers have gone from having, around about 20% debt to GDP. So 1/5 of their economy was indebtedness at the consumer level about 5 years ago. So very little mortgage debt, credit cards, that kind of stuff. You've now gone to about 50%, and they're now looking to rein that back in. And guess how that feels for the guys who've got a lot of credit? It feels lousy. So the Chinese local punter feels lousy about that. They get less credit at worse terms and higher rates than they got, say, a year ago. So that affects how they feel, which is why you're seeing this one of the reasons why you're seeing this really quite pronounced downturn in Chinese equity markets. But you'll say to me, it's China, so it's all rubbish, we can't trust the data. But we can see all of their trading partners, we can see all the businesses who trade with them. You can actually get a lot of insights here. And just to give you an example, this is South Korean exports. So again, big dip in the GFC. South Korea was much more affected by the GFC. Similar pattern though, recovery You don't grow for years, and then you have a bit of a dip into 2015, and again you've started growing once more. So, exports out of Korea in October were pretty chirpy. Now, the negative story around that is maybe you're drawing forward exports in the supply chain to escape the tariffs. So, you might be a bit of an effect of that, but the aggregate level of activity is pretty good. So I just want to move on to Europe. Now, I love this cartoon. It's meant as lampooning the Europeans. It's meant as mockery, but it's one of those lovely examples of many a truth in jest. So just to explain it, you've got Angela Merkel, Mutti, or Mummy as they call her in Germany, down the bottom of the boat, weighed down by her enormous purse. And she won't share any of her hard-earned with the naughty 27 boys at the other end of the boat. And they were all boys back then. It was before Theresa May. So this is a good summary, actually. It's meant as a joke, but it's a good little summation. And if you want a sort of very quick summary of the last 10 years of economic history in Europe, Germany won. That's sort of the thing you need to remember. Now, what do I mean by that? Now, these lines are sort of a bit dry, but they're incredible in their impact. So on the left, you've got all the Anglo guys. New Zealand's pretty similar. So Australia, UK, Australia. We all have these structural deficits, current account deficits. Look at what the pigs, so Portugal, Ireland, Italy, Greece and Spain, have done. They've completely changed, utterly transformed the way they finance their economies. So what that means is Greece used to need 14% of someone else's money to run their economy. And they now need almost none. And they're pretty much the worst. Well, the French are not great either, but all the other guys have gone from needing someone else's money to run their economy to generating more money than they need in their economy and structurally saving. Right? So that's what that Angela Merkel cartoon is summarising. Germany won that debate. Now, to put that in some context, what does that mean? In Australia and New Zealand, it's through our banking system. Our banks, well, they're all the same banks, they need foreign funding. So they go to wholesale markets, they get foreign funding in order to be able to lend people money. Right? We don't have enough loans in the system to do that. The Europeans are now largely inured to that. They don't suffer from that. What's the importance of that? They're much more insulated from shock. So if you're relying on someone else's money and they take it away, you're in a bit more trouble than if you've got your own money. And Europeans feel pretty good. So this is consumer confidence. Now you might think that Europe's hopeless and it never gets confident. They're almost at 30-year high levels of consumer confidence. They feel pretty good. Now it's not surprising. The Eurozone 28 has added 2 million jobs in the last year. So this place is recovering, pretty well, but it's also not the same as that level of optimism 10 years ago, because optimism with your own dough, which is a fair bit better than optimism on someone else's coin, because they can take that away. So it's both safer and also beginning to feel pretty reasonable. So please don't assume that Europe is this horrible place that has these internecine struggles and never improves. It actually has. You've had very significant reform. So just to summarise what I mean by both of those stories. The first is the Asian juggernaut of China has massively reformed its economy. It's not complete, by the way. It's still undergoing that process, but you're 7 or 8 years through a very fundamental reform process. And Europe has this incredible change in the way it finances itself and is now beginning to feel pretty good. Neither of those stories get terribly well presented. Now, just to give you some numbers about why any of this matters. So what I really want to disabuse you of is the notion that everything in the world is expensive, because lots of the world is very, very cheap. Right? So there are some things in the world that are very expensive, and there are some things in the world that are just laughably cheap. And here I demonstrate a few of them. So, you know how I was saying before, finance guys are dumb and they like to complicate things? So I want to get away from that and just talk about that earnings yield thing before. So you can go and buy these businesses. Don't worry about what we do. You can go and buy them yourself on, ComSec or something. BMW, Daimler, Samsung, hopeless businesses, right? They're sure to die, aren't they? They don't do anything useful. You can go and buy these on teens earnings yields. Now, that's for a reason. It's because they're all cyclical. right? And it's not, I don't want to give you the sense that it's US versus the rest of the world. This last guy is Lennar, that's a home builder in the States. So it's not just, even within the States, all the banks, all the home builders, all the autos, all the capital goods, they've all been sold off this year as well. So these cyclicals globally are lousy. Now markets are telling you that the world is hopeless. So BMW is on the same valuation as it was in 2009 today. Now maybe that's right, but maybe there's a chance that the difference between absolutely horrible and not that bad makes you quite a bit of money, because as things go from horrible to not that bad, prices go up quite a lot. And that's what we're observing globally. So to put that in a framework that we use to think about the world, just a simple 2x2 matrix. We all see the world feelingly. We all feel our way through issues. So when I say to you 2 + 2, you have an instinctive hardwired response. You know, when I say to you capital of Russia, you have a hardwired response. But now if I say to you, let's buy a bank in China, you can't trust that response. It might be the right initial response, but you can't trust that hardwired thing. That hardwired response is designed to get you through, you know, running away from bears and lions and that kind of stuff. It's not designed to get you to quantitative, serious outcomes. So facts versus feelings, or high conviction, low conviction, versus data. So good data, bad data. And where you get really interesting stuff is where your conviction is very high or very low, and that doesn't accord with the facts. So just back to that extension of valuation earlier, so software and US market stuff was very, very expensive. That's because it feels great. It feels awesome. And maybe you'll be right, by the way. Maybe if you pick Amazon in 2000, so if you get Amazon like April 1st in 2000, you make some money. It takes you 10 years, but you make some money. So maybe you'll get that one. But maybe you might buy LookSmart, Kaz Computing, Volante, Pets.com, and the other hundreds of businesses that disappeared. Because, you know, you've got to back yourself to pick the one that feels awesome and is awesome, which is pretty tough. On the other side of the coin, you've got all of these things that are terribly, terribly cheap. So metals, China, so the entire bulk shipping industry, the entire offshore oil and gas services industry. You know, these things are trading at as cheap as they've ever been on assets. So very, very cheap. So the summation of all of that is, in a world that's not too bad, it's not too hot, not too cold, growing at about 3%, you're getting all of these cyclical businesses that are terribly, terribly cheap and can make you some money, but it doesn't feel good. It feels very uncomfortable, actually. Or you can go and buy stuff that feels awesome, and you're just going to pay quite a bit for it. So that's the setup. And that's actually a pretty good setup for making money, right? So the last thing I want to say to you is, when everybody feels awesome about markets, please run for the hills. When everybody is in discord and doesn't know, that's a pretty functional series of markets, right? And when everyone's terrified, please buy everything you possibly can, right? You've got to remember that the herd is very important and you want to head the other way. You know, that's the end of my prepared remarks. Please throw your curly questions at Care from henceforth.